15 minutes. That is the number nobody in financial media wants to talk about. 15 minutes before President Trump posted his announcement on March 23rd, 2026, the announcement that sent oil prices crashing more than 10% in a single session, someone placed $580 million in bets that oil prices were about to fall. Not after the announcement, not during the announcement, 15 minutes before a statement that did not yet publicly exist. $580 million, positioned perfectly before the rest of the world had any idea what was coming. Now, I want you to sit with that number for a moment, because most people saw that detail scroll past in the footnotes of a Financial Times investigation and kept moving. They went back to watching the headline number, watching whether the S&P was up or down that morning, watching whether Trump was going to extend his deadline again. And that is exactly the problem. Everyone is looking at this wrong. And by the end of this video, you will understand precisely why. You will have a framework for reading what the data is actually showing. And you will know the specific dates in April that will tell us whether this ends as a footnote in market history or as the event that defines a generation of investors. Everything I am about to walk you through is analytical commentary, grounded in verified, publicly available data from institutions, including the International Energy Agency, Goldman Sachs, BCA Research, Capital Economics, and the Federal Reserve. This is pattern recognition built from real numbers. It is not financial advice. Nobody knows with certainty what markets will do on any given Tuesday. Make your own decisions with your own money, but do not make them without understanding what the data is quietly, patiently telling you. Let me start with the physical reality of what is happening in global oil markets right now, because this is the foundation that every other piece of this analysis sits on top of. The Strait of Hormuz normally carries more than 20 million barrels of oil per day. Think about what that means in practical terms. Roughly a fifth of the world's entire daily oil consumption passes through a waterway that is, at its narrowest point, about 21 miles wide. The International Energy Agency has characterized the current closure of that strait as the largest supply disruption in the history of the global oil market. Not the largest disruption in recent memory, not the largest since a particular decade, the largest ever recorded. To put that in historical context, the Arab oil embargo of 1973 cut global supply by approximately 4.5 million barrels per day. That event sent the S&P 500 down 44% and produced 6 years of lost returns. The current disruption is more than 4 times larger in volume terms. And I want to be precise here, because precision matters more than drama. The world also consumes considerably more oil today than it did in 1973, which moderates the percentage comparison somewhat. But the fundamental point stands. The supply disruption that produced the single worst geopolitical market event in modern history was smaller on a physical basis than what is happening right now. That is not a reason to panic. It is a reason to stop relying on the comfortable historical average and start asking more specific questions. Here is the framework I want to use to walk through the current situation. Because the mistake most people make when analyzing something like this is treating it as a single event rather than a multi-layered structural problem. There are 4 stages to understand. The first is the primary shock itself, which we have already established is the largest supply disruption ever recorded. The second is what I call cushion absence, which refers to the economic and financial conditions that exist before the shock hits. The third is the lock effect, which describes the mechanism by which a supply shock interacts with monetary policy in ways that remove the central bank's most important tools. And the fourth is the cliff, a specific calendar-driven moment when supply buffers exhaust and the physical shortage becomes unmitigable by policy tools. These 4 stages working together create a completely different risk profile than the simple historical average suggests. And understanding each one individually is the only way to evaluate what the data is actually telling you. Start with cushion absence, because this is where the current situation departs most dramatically. From the template, the consensus keeps applying. Every major oil shock in the modern era has had some form of natural cushion that absorbed part of the blow. In 1990, when Iraq invaded Kuwait and Brent crude spiked sharply, the shock was real and disruptive. But the American economy was in the relatively early stages of what would become a long expansion. Stock market valuations were moderate. And critically, the Federal Reserve had significant room to cut interest rates. That flexibility turned out to be the decisive variable. The S&P 500 fell roughly 15 to 16% in the weeks following the invasion, and then recovered fully within months, not because the geopolitical crisis resolved quickly, but because the Federal Reserve pivoted aggressively, cutting its benchmark rate multiple times over the following year, from 8% down to 5.5%, providing direct monetary stimulus to offset the supply shock. In 2026, those cushions are absent in 3 directions simultaneously. The first cushion that is missing is valuation. According to analysis published by Financer in March 2026, the Shiller-Cape ratio, which measures stock prices against 10 years of cyclically adjusted earnings to smooth out the boom and bust cycle, stood at 39.8 as of early March. That is the second highest reading in 150 years of market history. The only time it was higher was at the peak of the dot-com bubble in 2000, when it reached 44.19. And what followed that reading was a 50% decline in the S&P 500 over the subsequent 2 years. Historically, whenever the Cape ratio has exceeded 39, markets have averaged negative 4% returns over 1 year and negative 20% over 2 years. This is not a prediction. It is a base rate. It tells you the starting altitude, and starting altitude determines how far the fall could be if the structural support gives way. The second absent cushion is monetary policy. The Federal Reserve left interest rates unchanged at its March 18th meeting. Not because the economy is in perfect health, because the Federal Reserve is caught between two competing emergencies. Oil prices that have risen more than 60% since late February are feeding directly into inflation readings. Elevated inflation ties the Federal Reserve's hands. If they cut rates to support growth, they add fuel to an oil-driven inflation surge. If they raise rates to fight inflation, they risk accelerating a recession that multiple models suggest is already approaching. Goldman Sachs strategist Dominic Wilson wrote publicly that the Federal Reserve faces a genuine stagflation dilemma if the oil shock persists. That is not outsider commentary. That is one of the most prominent economists at one of the world's most powerful financial institutions, describing the Federal Reserve as trapped. And as CNBC reported in late March, bond prices have been falling alongside stock prices, with Treasury yields rising to 4.4% as investors price in fewer rate cuts and higher inflation simultaneously. In a normal shock, bonds rally when stocks fall. Investors flee to safety, driving bond prices up, when both asset classes decline together, as they did in 2022 and are doing again now. There's no traditional safe haven absorbing the impact. The entire portfolio structure locks. The third absent cushion is recession risk. Moody's recession probability model stood at 49% as of February 2026. And that was before the full economic weight of the oil shock had registered in the data. That model's historical track record, when backtested over 80 years, shows that every time it has crossed 50%, a recession followed within 12 months. We are sitting at 49% with an unresolved oil shock adding inflationary pressure. That makes it harder, not easier, for the Federal Reserve to respond. The building's pipe has burst, and the backup systems are not working. Now, let me take you through the 3 historical case studies that this analysis depends on, because the consensus keeps reaching for the wrong comparisons, and the specific details change the picture entirely. The first case study is 1973, the one everyone cites but nobody actually examines closely. The mainstream version of the 1973 story is accurate in its headline numbers. The S&P 500 fell 44%. It took 6 years to recover. Most analysts stop there, fold those numbers into a 20-event historical average, and use that average to reassure investors that geopolitical events are historically buying opportunities. That is not analysis. That is data averaging, masquerading as wisdom. Here is what actually happened. On October 15th, 1973, 4 days before the Arab members of OPEC formally announced the oil embargo, the stock market was down modestly from its recent highs. Most analysts characterized it as an ordinary cyclical correction. The oil embargo did not create the conditions for a 44% decline out of nowhere. It amplified a fragility that already existed in the structure of valuations and earnings expectations. The Shiller-Cape ratio in October 1973 was elevated not at the extremes of 2000 or 2026, but stretched relative to historical norms, making the market more sensitive to an earnings shock than its surface level suggested. Corporate earnings were being sustained in part by assumptions about continued economic expansion that an oil shock directly invalidated. And then, the critical detail that almost nobody discusses. The Federal Reserve in October 1973 was already tightening monetary policy. When the oil embargo hit and oil-driven inflation accelerated, the Federal Reserve did not and could not pivot. It could not abandon the inflation fight entirely without losing all credibility. The combination of supply shock, elevated valuations, and locked monetary policy produced a decline that bore no resemblance to the average event. Because 1973 was categorized as a war-related event, it gets averaged together with the Gulf War, the Ukraine invasion, the Korean War, and 19 other events where oil shocks were smaller, valuations were lower, and monetary policy had room to respond. That arithmetic produces a 6% average that is technically accurate and analytically useless for evaluating the current environment. According to RBC analysis, the S&P 500 dropped 16.1% in just 42 days after the 1973 Yom Kippur War began, and did not recover those losses for 6 years. That is the outlier in the dataset. And the outlier is the event whose structural fingerprints most closely match 2026. The second case study is August 1990, and this one is the most dangerous comparison in the current consensus toolkit, because it sounds so reassuring. Iraq invaded Kuwait on August 2nd, 1990. The S&P 500 fell roughly 15 to 16% in the weeks that followed. It recovered fully within months. The conventional framing presents this as Exhibit A for why the current situation will resolve itself. Markets bounced back from a real oil shock and a real geopolitical crisis. They will bounce back again. Here is what that framing consistently leaves out. The recovery in 1990 was not the result of the market being inherently resilient to oil shocks. It was the direct result of the Federal Reserve having the flexibility to cut rates aggressively in response. That flexibility was the decisive variable, and that variable is not present in 2026. The Shiller KP ratio in August 1990 was approximately 17, roughly half of its current level. Corporate earnings had room to absorb a shock without collapsing the entire multiple structure. When you remove the Federal Reserve's ability to cut rates, which is exactly what the current inflation environment does, and you start from a CAPE ratio of 39.8 instead of 17, the 1990 episode looks dramatically different. The 15% drawdown in rapid recovery was a specific outcome produced by specific conditions. Those conditions do not exist today. Using 1990 as the template for 2026 requires assuming that a variable we know is absent is actually present. That is not reassurance. That is an error. The third case study is the most recent, and because it is recent, most people are still inside it, which is exactly why the structural signal is being missed. On February 28, 2026, the United States and Israel launched joint military strikes against Iran. On Sunday, March 1st, futures markets were pricing in a severe Monday open. The Dow Jones was indicated sharply lower. Oil had spiked 36% in a single week. The VIX, Wall Street's fear gauge, had risen from the mid-teens to a high near 32. Across financial media, the tone was dire, and then Monday, March 2nd arrived, and the S&P 500 closed essentially flat. Technology stocks rallied. Investors bought Nvidia and Microsoft. The conventional red was immediate and confident. Markets are resilient. Geopolitical events do not cause crashes. Historical base rates confirmed again. Here is what that reading missed. The recovery on March 2nd was driven by a single statement from President Trump characterizing the operation as a targeted strike. Market participants priced in a quick resolution. They were pricing in the average scenario, not the 1973 scenario. Between March 2nd and March 26th, the S&P 500 did not recover to new highs. It drifted steadily lower, hitting a new low for 2026. The Nasdaq entered correction territory, down more than 10% from its peak by late March. The initial bounce was not a recovery. It was a sentiment-driven reprieve inside a deteriorating trend. That is the fingerprint of 1973. The structural pressures, locked monetary policy, elevated valuations, sustained supply shock, were not resolved by any of those rallies. They were simply paused. Now let me bring you to the specific mechanism that makes the coming weeks different from the general pattern I have been describing. BCA research analyst Marco Papik published an estimate this week that the world has lost between 4.5 and 5 million barrels of oil per day. After roughly April 19th, his analysis projects that number is expected to approximately double, reaching roughly 9 to 10 million barrels per day. Why does the number double? Not because of a military escalation, but because government tools to cushion the shock run out of effectiveness. The International Energy Agency released 400 million barrels from strategic reserves on March 11th. That sounds enormous. In the context of Hormuz flows, it compensates for approximately 20 days of normal throughput. And when those 20 days of buffer are consumed, around mid-April, the physical shortage becomes unmitigable by any policy tool currently possessed. Goldman Sachs states that if Hormuz flows remain at 5% capacity for 10 weeks, Brent crude prices will likely exceed $147. That 2-month window at current trajectory points directly into the April and May period. This is not a theoretical risk scenario. It is a supply math problem with a scheduled arrival date. Now I want to connect this to the Sunday night pattern. CNN's analysis noted Trump's suspiciously market-timed announcements. His March 21st ultimatum was issued on a Saturday evening. His March 23rd reversal, which sent oil prices crashing more than 10%, came Monday morning before markets opened. The pattern is consistent. Monday morning market opens have become geopolitical event horizons. The market is not reacting to fundamentals. It is reacting to Sunday night binary events. Does the statement come before the open or after? In a market where the decisive variable is a weekend statement, information asymmetry is not just an edge, it is the entire game. The April 6th deadline is set to expire on a Monday at 8 p.m. Eastern Time. If that deadline passes without a new extension, the next trading session opens Tuesday into an unresolved ultimatum. But the extension does not change the supply math. The buffer continues depleting whether the deadline is extended or not. The physical shortage arrives around April 19th, regardless of what any statement says. That convergence represents a 13-day window that the current consensus is not pricing. Let me give the bull case its full weight, because intellectual honesty requires it, and because the arguments are genuinely serious. The first argument is American energy independence. The United States in 2026 is not dependent on Middle Eastern oil the way it was in 1973. Domestic oil production is near record highs. The United States is the world's largest oil producer. The spread between Brent crude, reflecting global scarcity, and West Texas Intermediate, reflecting domestic supply, exceeded $14 per barrel on March 23rd. That spread is the data signature of American relative insulation. Europe, Asia, and emerging markets suffer more from a Hormuz closure than America does. That is a genuine structural difference from 1973 that moderates the comparison. The second bull argument is base rates. 19 of the 20 major geopolitical events since World War II saw the S&P 500 recover its losses. The historical frequency of recovery is 95%. Positioning as if this is the one exception means betting against a base rate. That is not irrational. That is how probability works. Most of the time, the dip is the entry point. The third bull argument is Trump's own pattern of behavior. Every extreme statement has been followed by an extension, a pause, or a qualification. Diplomatic channels through Pakistan and other intermediaries remain active. A deal that reopens the strait would trigger an oil price collapse. This would be simultaneously anti-inflationary and pro-growth. If that deal arrives before April 19th, the bull case wins decisively. These three arguments are real, and I hold them seriously. But there is one number that keeps me from being persuaded. BCA Research's projection of supply loss doubling around April 19th is the mechanical result of stockpile releases running their course. It arrives on a fixed calendar whether or not a diplomatic announcement comes. The bull case requires a deal before the strategic buffer exhausts. The deadline on the table is April 6th. The supply cliff arrives around April 19th. There's a 13-day window of physical vulnerability. If those 13 days pass without reopening the strait, Goldman Sachs projects oil could approach or exceed the 2-and-8 record of $147 per barrel. Combine that with a CAPE ratio of 39.8 and a Federal Reserve with no room to cut rates and the 1973 outlier is present. The structural conditions for the 1973 outlier are present in a way that no other event in the dataset has reproduced. Here is my actual read on where we are, stated as plainly as the data allows. The market, as of late March, is pricing the probability of another Trump extension on April 6th, because he has extended twice already. Diplomatic channels remain open. That extension probability is real, and it may very well happen. But the supply math after April 19th is not a diplomatic variable. No announcement postpones it. No statement at 8 p.m. on a Sunday changes whether the IEA's strategic reserve release has reached its effective limit. The highest risk window is not this coming Monday. It is the 2-week period between April 6th and approximately April 19th. If April 6th produces another extension, watch what happens to oil prices in the days that follow. If they resume climbing toward Goldman Sachs's projected averages instead of falling, that is the signal of physical reality. There are 4 things worth paying attention to with genuine urgency right now. The first is liquidity. In March 2020, off-the-run Treasury securities became effectively unsellable for several hours during peak volatility. Concentrated equity positions in sectors that benefit from stable global supply chains are worth reviewing now, before a volatile Monday open forces decisions under pressure. The time to understand your exits is before the situation demands them. The second is the 3 dates that will tell the most. April 6th, the window through April 19th, and Fed communication. Whatever happens in those hours on April 6th will drive the April 7th open. Any Federal Reserve communication that signals a shift in balancing inflation against recession risk is critical. If the Fed prioritizes recession prevention over inflation fighting, that is a regime change that fundamentally alters the risk picture. The third thing to watch is the Brent crude forward curve, specifically the spread between spot and 1-month prices. When short-dated oil becomes significantly more expensive, that is the signal that physical shortage is arriving ahead of projections. Goldman Sachs identified this condition as the precursor to their worst-case oil price scenario in their March 23rd analysis. The forward curve is public data. It is one of the clearest signals available of whether the supply math is worsening. The fourth is the distinction between volatility and repricing. The current drawdown of roughly 7% from the January peak, as of late March per CNN Business, is not yet at the level that historically represents maximum pessimism. It is within the range of normal geopolitical correction. The relief rallies that have occurred within that decline, March 2nd being the most prominent, are pattern consistent with the 1973 episode, where multiple bounces occurred inside a larger downward structure that took 11 months to complete. Each bounce was interpreted at the time as confirmation that the worst was over. The structural pressures were not resolved by any of those bounces. They were simply paused, while sentiment temporarily prevailed over supply math. Let me close with the observation that started this entire analysis, because it is the most honest lens through which to view everything that follows. $580 million, positioned 15 minutes before an announcement that did not yet publicly exist, that sent oil prices crashing more than 10% in a single session. I am not making a legal claim about that trade. I'm making a structural observation about the market we're all participating in a market where Monday outcomes are determined by Sunday night announcements and where the most sophisticated and best connected participants position themselves. Before those announcements arrive in public, the analytical question is not whether you're smart enough to trade around these events correctly. The question is whether you're honest enough to recognize which side of that information gap you are standing on. Most of us are on the side that finds out when the announcement posts. The data is not hiding. The CAPE ratio at 39.8 is public. The IEA's reserve release calendar is public. Goldman Sachs's price projections are public. BCA Research's supply cliff estimate is public. The Federal Reserve's rate decision and their language about elevated inflation is public. The April 6th deadline is public. What is not public is what Sunday's announcement will say before Sunday arrives. The consensus built around the comfortable historical average, the 19 out of 20 base rate, the buy the dip framework, was built to be right most of the time, and most of the time it is right, but it was never designed to identify the 20th event. It was never designed to weight a CAPE ratio at 39.8, locked monetary policy, and the largest supply disruption in history simultaneously. It was designed to produce a reassuring 6% average that keeps participation high and positions intact. The supply math does not care about the average. It cares about the calendar, and the calendar says April 19th. Watch what happens between April 6th and April 19th. Watch the oil forward curve. Watch whether the Federal Reserve's language starts shifting. Watch whether the bounces hold or roll over. The data has been telling the same story for weeks. The Sunday emergency orders are not the event. They are the pattern. And the pattern has not changed since February 28th. Only the deadline has moved. Watch carefully. Because in the next few weeks, the data will tell us definitively whether this is the 19th or the 20th. And historically, by the time the 20th is obvious, the cost of finding out is already priced into your portfolio.